Hi Team Value, JJ here, welcome back. Well, today I'm going to dive into the actual numbers for Tesla Q1. They weren't great numbers. Yesterday I did the earnings call, reacted to what Elon and others were saying on that. They were telling a good story of future story and the stock price went up. But we do have to look at the actual numbers. A lot of investors don't do that, especially the pumper Tesla channels on YouTube. Definitely just skip over the numbers. So we're going to dive into it because it's important. And there will be an extended version of this on Patreon if you're interested in that. I'll leave a link in the description to that. But let's get into what the numbers say. We'll go through the investor deck, not skipping out the important numbers. Okay, this is the Tesla Q1 2024 update. So I've noticed in a lot of Tesla pumper videos, they don't go through the numbers, skipping down to what looks positive. But we're serious investors. We're going to have a look at the actual numbers, whether they're good or bad, and interpret them as investors rather than just sort of acting as cheerleaders. It's important to be critical, look at the positive and the negative. Let's skip down to page 12 and see what the pumpers are into first. Electric vehicle adoption rate remains under pressure, especially outside of China. But this is the global BEV market share, and we can see that it's pretty low. So there's a lot of upside, in terms of the addressable market, people converting to EVs, transitioning to EVs. There's still a lot to go. We can see China and the rest of the world just under 5% there. So there's still a lot to go, and that's true. I am for the transition to EVs. I think it's going to happen probably a lot quicker than a lot of people think. So there is a lot of upside to go, but that doesn't mean we shouldn't look at the numbers. And here, of course, we can see the Tesla ecosystem, and you'll notice robots, humanoid robots right at the top there. It's not generating any revenue. This is the future, the upside for revenue possibly. And we can see a lot of these things here that aren't really generating much revenue. Of course, the automotive is the vast majority of the revenue. We'll see that. And then insurance off that, charging, humanoids and AI compute, FSD, and ride hailing, which they've put in this presentation, some pictures here. But all of these things, energy storage is going pretty well. That's one thing that's positive. But the ecosystem that isn't built out yet, we need to look at what is actually making money today rather than the future. And the stock price went up a lot, even though the numbers weren't great. And it's because Tesla is sort of spinning the story of future developments. I think that they can happen, but looking at the business today rather than too far into the future. And Elon's timelines are always pretty optimistic as well, aren't they? Here we have a preview of ride hailing, and this is a rendering. This, as far as I know, this doesn't actually exist. It says actual look and features subject to change. This is basically a mock-up, a rendering of how the app should look. I'd be interested to know if they do actually have one of these going yet. I have designed apps before, and I can tell you that this is what you do when you mock up an app, a future app. So I don't know if this is even actually existing yet. Maybe, surely they'd be testing it in the background, but that's just a rendering. There's a lot of positivity about this, but anybody can do a render. And this one here says not a render. They say training cluster of Dojo, which is actually working. So that's good that that's not a render. And here we have the Megapack, which is a positive part of it. We'll actually have a look at some of the numbers for Megapack, see how that is actually going. But that is a growth area. This is an energy storage facility in operation, and you can see that they have a lot of Megapacks there. That looks like a serious operation. That's good to see. Here we have the Tesla Semi site of construction near Gigafactory, Nevada. So this is pretty funny actually, because it's just a cleared bit of land. They're preparing it. This is the very beginning of it. Actually, it doesn't look like there's a huge amount going on there. They haven't started construction. Timelines that they talk about, the semis being sort of in production. I think they said late 2025, they said in the earnings call, and it doesn't look like that's going to be the case. That seems optimistic compared to where that is now. Maybe they can do that in like less than a year and a half. We'll have to see, but that seems pretty optimistic to me. This is actually a really interesting slide here of the cost grind, squeezing every penny out of the vehicle cost, assuming that that's everything that goes into a vehicle, sort of saying how can we cut costs here on every single component. So they have been driving down costs like that. Elon mentioned that, even a sticker. Why is that sticker there? Do we need that? Driving out every penny from the Cybertruck in particular. Although it's not cheap, I mean, it's an expensive vehicle. Here we have some of the key metrics, or the metrics they're choosing to give us. Vehicle deliveries, and notably pretty way down here for Q1 2024. And really, there's been other quarters where it's gone down, but that's a marked drop there. Considering that they lowered prices in order to increase volumes or keep volumes up, that looks like that hasn't been done just from that. Operating cash flow versus free cash flow here. Oh, that hurts. If we go back here, we can see that that is way down, the free cash flow. And we'll see that in the numbers way down, and also operating cash flow way down. Not great, not great. And so the share price went up based on this. It's really to do with the narrative that they've been managing to spin, as far as I can see. And net income versus adjusted EBITDA here. And we can see that the red adjusted EBITDA is sort of not down too much. And I'll show you what Charlie Munger in particular said about adjusted EBITDA. This is a quote, a quip from Charlie Munger. He says, "Every time I saw the word adjusted EBITDA, you just substituted the phrase with BS earnings." So something to keep in mind about adjusted EBITDA. So there's the same metrics for the trailing 12 months. Vehicle deliveries here. So we see a drop. They dropped the prices in order to sell more volumes. That was the story, but that really hasn't worked. They're kind of trying to keep volumes from dropping way low here. We can see that it's a sort of smooth curve up there, and then not leveling off, just actually going down for it. So that's kind of concerning. It's turning out that Tesla is actually more cyclical, and we're just seeing that now. The auto industry is known as cyclical, and a lot of people said that Tesla wouldn't be like that given the huge demand for EVs and this transition to EVs, but it is actually seems to be turning out like that. We have operating cash flow and free cash flow there. We see free cash flow way down there. Now, I know there are people out there, the Tesla cheerleaders, looking for confirmation bias, who won't like what I'm saying here about the numbers, and they'll probably hit the thumbs down button. So if you are getting value out of this episode so far, please remember to smash that like button to help this episode to spread to more people. Thanks. Now, they say we experienced numerous challenges in Q1, which they outlined in the earnings call. Again, link in the description if you want to go and see that. Went through some of the key points in the earnings call and reacted to it. So they say from the Red Sea conflict and the arson attack at the Gigafactory Berlin to the gradual ramp of the updated Model 3 in Fremont. I mean, those things are real, but they do come across kind of excuses here. Excluding Cybertruck and unscheduled downtime, our COGS per unit declined sequentially, driven primarily by lower raw material costs. So, COGS going down, cost of goods sold, that's good, driving out those costs at every penny. Global EV sales continue to be under pressure as many car makers prioritize hybrids over EVs. Other car makers are pivoting to more hybrids rather than pure EVs. Tesla's just going hard with the EVs. While many are pulling back on their investments, we are investing in future growth, including our AI infrastructure, production capacity, our supercharger and service networks, and new product infrastructure, with 2.8 billion of capital expenditures in Q1. So, investing for growth there. But at the same time, we recently undertook a cost-cutting exercise to increase operational efficiency. So thinking about the jobs, they cut 10% of jobs there. Ultimately, we are focused on profitable growth, including by leveraging existing factories and production lines to introduce new and more affordable products. So, that's playing down new factories there, saying that we're going to optimize the factories that we've got, the space that we've got there, and cost cutting. And they didn't mention the job cuts there. I noticed the future is not only electric, but also autonomous. We believe scaled autonomy is only possible with data from millions of vehicles and an immense AI training cluster. We have and continue to expand both to make FSD, full self-driving, and in brackets there, supervised FSD, more accessible. We reduced the price of subscription to $99 a month and the purchase price to $8,000 in the US, lowering the price to get it out to more people. And he's talked about test drives, getting people to try it out with a test drive, and encouraging people to try FSD in the current version because he said it's profound. Okay, let's get into the actual numbers. numbers, which a lot of Tesla pumper channels just gloss over or don't even show at all. But we need to see them if we're investors or potential investors with Tesla. We need to see what's actually going on in the business, and this is how we do it. So this is dollars in millions. So we see total automotive revenues is 17,378, which is 17.3 billion, and that's down 13% year on year. We can see back a year ago it was 19.9. Energy generation and storage revenue up 7%, which is not as much as you would want. It is going in a good direction. Definitely the growth area of the business, although not high growth at this point. And services and other revenue, 25%. That is a good story. That's good growth there, and more than energy generation and storage at this point. So that's good to see. And again, we can see the story going over, previous quarters. That is getting higher. That is looking good. But, compared to auto revenues, still quite small there. And total revenues, 21,301. So that's down 9%. Not a great story there. We can see going back over quarters, 23, 24, 23, 25, and down to 21. So that's disappointing there. And we can see total gross profit down 18% there. And going back over the quarters, a year ago it was 4.5, then 4.5, 4.1, 4.4, and 3.696. So quite a significant drop there, 18%. And total GAAP gross margin, 17.4. There's a lot of talk about margins, and here we are. We can see a year ago 19.3 down to 18.2, 17.9, 17.6, and now 17.4. So margins going down, but are volumes going up? We'll have a look at delivery numbers, but really that was the idea, but it's more like trying to save volumes than increase volumes at this point. So operating expenses up 37% there. So that's a figure that you don't really want to go up. So a year ago it was 18.47, now 2.5, so significantly up. 37, there were reasons for that. Cybertruck's ramping. It's hard to keep costs down when you're introducing new models. But it's something that you'd expect with a growing company, although it's not really growing at this point. Income from operations, another important number, minus 56%. So that is a number that you would think would put the share price down. And of course, the share price has been dropping, but it did go up after the market saw this. After Wall Street and retail investors saw this, it went up. So that's kind of surprising when you see a number like that, income from operations at minus 56. And we can see back on the quarters, it's, significantly down from the quarter before and from a year ago, significantly down. Quite a shocking number there. Operating margin, again, talking about the margins, this is an important number, 5.5%, which is pretty low. That's pretty disappointing. And you can see a year ago it was 11.4, and even that wasn't so great, really. And 9.6, 7.6, 8.2, and now 5.5. So these are pretty disappointing numbers. It's really surprising that the share price, bounced on these earnings, and it was because of the story, the future, talking about robots, talking about robo-taxis around the corner. But really looking at the numbers, these are not great. The net income attributable to common shareholders is down 55%. They're not a great number in there. And then GAAP and non-GAAP, 55 and 48. So those numbers hurt. Of course, EPS also down similar amount there. And we go here to net cash provided by operating activities is down 90%. 90%. I mean, no investor would like to see that at all. This is probably why a lot of Tesla pumpers glossed over this completely, because that's kind of a shocking number there. A year ago it was 2,513, now 242. And capital expenditures there, it's up 34%. And free cash flow, 674% negative. So that's kind of a shocking number there too. So that they talked about that in the earnings call. They think they'll return to free cash flow positive in the next quarter. So that'll be interesting to see. We can see there it was 441. Remember, this is millions a year ago. And then over $1 billion and 848. And then 2, impressive number for Q4 2023. And then negative, turning negative again. So disappointing there. Cash and cash equivalents and investments, pretty good there. They've got a good amount of money. There's no problems with that with Tesla. So that's 20% up. And here we have the operational summary, which is important as well. We can see the Model 3 and Y production, which they don't break out separately. I wish they did. But anyway, it's 412.3 thousand there, and that's 2% down. We can see the figures from the previous quarters and other models 20.9. So overall, it's 2% down on 433, which is, we can see significantly down there from previous quarters, which is disappointing, considering that they lowered the price. There's production and then there's deliveries. So we can see Model 3 and Y deliveries down 10% and other model deliveries up 59% and total deliveries down 9%. So they've lowered costs of things and the deliveries have actually gone down. So they're not intended to be that way. Elon said that they'll make it up in volumes, but that isn't turning out to be the case. So this one here is important, storage deployed, because that's a growth story, but it's only 4%, and that's around 4,000. For a year ago, it went down, and then it's been going up, sort of fluctuating there, but 4 is a good number there, really. Tesla locations, 26% up there. Mobile service fleet is 12%. Supercharger stations, 26%. There's some positive numbers there, but the important ones are actually down in terms of production and deliveries. Those are really important because it is mostly autos at this point. Yes, it's not just an auto company, but the vast majority of revenues are from autos at this point. So it is important, and these numbers aren't looking great. And I encourage you to go through this if you are an investor or you're a potential investor in Tesla. I'd encourage you to do that. It really is important to dive into the numbers and have a look. Now, as I said, there'll be an extended version of this video on the Art of Value Patreon. If you're interested in checking that out, I'll put a link in the description. And right now, if you're watching this video on YouTube, I'm going to put a link here to the video that YouTube thinks that you in particular should watch next. So go and see that now if you want to. And thanks to everybody for watching or listening on whatever platform you're doing that on. And I'll see you in the next one.